In this week's Red Cloud Research Roundup, we're introducing a new member of the Red Cloud Securities research team. Joining us is Ron Stewart, Managing Director of Equities Research, bringing more than 30 years of experience to the table, focusing on the precious metal space. In this episode, he's going to discuss gold producer expectations as Q2 numbers start to get released. Then we have Alina joining us to discuss Bradda Lithium, which announced an updated resource estimate for its Basin Lithium clay project in Arizona. All this and more coming up on this episode. Alina, over to you.
Hi everyone. This week I wanted to talk about Bradda Lithium that announced an updated resource estimate for its Basin Lithium clay project in Arizona. We have a buy rating and 50-cent target on the stock, and I note that Bradda is not a banking client. So as we had expected, the resource for its Basin Lithium clay project is over the 2.5 million ton LCE mark. It came in at 2.83 million tons LCE, which represents a 160% increase over last year's estimate. Now, grades did decrease slightly by 9% to 822 ppm, but it's important to note that almost a quarter of this resource now sits within the M&I category. So this update was based on 8 holes that were completed at the Basin North claims, and I will note that while they were drilling, they intersected a continuous higher grade layer, which is near surface and about 15 meters thick. So this would likely be mined first in a production scenario, which bodes very well for future economics of the project. There is also plenty of exploration potential present on the property, and the resource area remains open to the north, east, and west. But we don't expect Bradda to undertake any further exploration work on the property, at least in the near term, given that the contractual obligations towards the LRC agreement have now been met. Just to remind everyone, Bradda was required to establish a resource over 2.5 million tons LCE, which they have done and has now triggered the last and final $3 million payment from LRC. So with the treasury now topped up, we expect focus to shift to its San Domingo pegmatite project, which is also located in Arizona. Plans are to conduct surface exploration work before additional drilling later this year. I'll just note that previous drill programs at San Domingo did not yield the continuity in mineralization that management wanted to see, so plans are now to go in and target new areas on the property. And that's all I had this week. I'll hand it over to you, Ron.
For those of you who don't know me, my name is Ron Stewart, and I'm delighted to have joined the Red Cloud team as an equity analyst. We have a lot of talented people here who are all dedicated to serving you with access to issuers and investment ideas that are aimed at making your life a little bit better. I'm looking forward to launching coverage on a suite of names and will be primarily focused on the precious metal and base metal sectors. I hope that I'll be able to help some of you along the way and from time to time have the opportunity to speak with you directly and share some thoughts about the industry and its players. What I'd like to talk to you today about is a bit of a heads up concerning the second quarter earnings when precious metals producers begin to report their results. Quarter over quarter in Q2, the gold price climbed 13% to average $2,340 an ounce, adding about $265 from its first quarter average. On the cost side, all-in sustaining costs in the second quarter are expected to come in around $1,400 an ounce. We estimate that number by tracking the performance of some 54 gold producers from Canada and Australia. What this means is that the average margin between the gold price and all-in sustaining cost is going to be over 40%, up sharply from the 33% we saw in Q1. That second quarter margin will be the second highest quarterly margin that we've seen over the past 5 years, eclipsed only in the third quarter of 2020, when the margin in our analysis peaked at about 48%. All-in sustaining costs is a non-GAAP measure that was introduced by the World Gold Council in 2013 to provide a comparable metric between producers that reflect the cost of producing and selling an ounce of gold. Under the guidelines, it's reconcilable with the accounts reported under GAAP and IFRS accounting standards. It's become a widely adopted metric across the gold industry as the go-to measure of the profitability of a mining operation or company. As I said, it's comprised of metrics taken directly from the income and cash flow statements. Cash operating costs are derived from the cash flow statement and include all direct mining, processing, and selling costs, realized mark-to-market hedge adjustments, non-cash-based remuneration, as well as byproduct and co-product credits. The contribution of byproduct credits are something to be mindful of because low-cost producers often report considerable credits of either silver, copper, or other related metals. We take care when we see these numbers because issuers who report gold equivalent production numbers or GEOs often will produce all-in sustaining costs both with and without byproduct credits. So you really need to be careful as to which metric you're using. As a general rule, I'm always wary when producers report GEO or gold equivalent production as opposed to the metals themselves, since some have been known to use their own prices to determine the total production number, which can distort the reality of what they're producing. Other items from the income statement include G&A costs, reclamation and remediation accretion, as well as some of the exploration spending. Sustaining capital costs are sourced from the cash flow statement. Here again, you need to be careful when you're looking at the capital cost allocation. Development capital is generally excluded from all-in sustaining costs, and companies can reallocate capital as a development expense to reduce their all-in sustaining costs. It's relatively easy to reclassify those numbers into either sustaining or development capital. Our data show that on average, all-in sustaining costs have been climbing at around a compound rate of 9% over the past 5 years. Looking back over that time frame, back in Q1 2019, cash costs ranged from $533 to $1,428 an ounce and averaged $890 an ounce. In the first quarter of 2024, all-in sustaining costs ranged from $693 an ounce to $2,799 and averaged $1,390 an ounce. So there's a wide range in costs between issuers. We like to track the distribution of all-in sustaining costs of all of these producers to identify which ones offer price protection against the volatility in gold price and which ones offer superior leverage or margin expansion. We also appreciate that acquirers are often reluctant to buy high-cost producers unless there's a compelling opportunity to revitalize the operation and lower those costs. It's also not uncommon to see major companies look to divest mature, high-cost assets as a means of lowering their cost profile and improving their margins. They always say, one man's trash is another man's treasure. All-in sustaining costs will continue to track on a quarterly basis going forward, and we will produce a chart that shows the distribution of the 54 companies that we follow in the space to give you, our readers, the opportunity to understand what the distribution of all-in sustaining costs are. Thank you, and I look forward to talking to you.
Thanks for listening to the Red Cloud Research Roundup podcast. We hope you enjoyed the dive into recent notable mining news and meeting the newest member of our team. Remember, you can join us every Monday for new episodes. And as always, head over to redcloudsecurities.com to read all of the research reports discussed, for all Red Cloud Securities free research reports, and to sign up to our email list. That's it for this episode, and see you next time.